Mortgage rates just spiked by the most since Liberation Day. 2 weeks ago, buyers were locking in the mid to high fives. Some were getting well below 6 for the first time since 2022. That window is gone. In a matter of days, rates surged to 6.35%, a 50 basis point swing. If you are in the housing market right now, you are going to want to hear this because most of the information people are getting about this market is already outdated by the time they see it. The reports that come out next month about March, those deals were done weeks ago. Here's a video from January where I reported on February price expectation.
Okay, so if we just use contract price, what we can see is I would expect prices to be about 1 to 2% higher than they were last year for February.
Here's something that WKRN just published.
The median price for a single-family home edged up to $499,900 from $489,900 a year ago.
By the time that data hits your screen, the market has already moved, and right now, it is moving fast. Now, interest rates have been skyrocketing, so what did this do to the monthly payment of home buyers on a $500,000 home with 20% down, a $400,000 loan? It's over $100 more per month. And yet, Nashville contracts are actually up about 5% year over year. More buyers are going under contract than in the same period last year. Now, there's two reasons for this. First, rates are lower than where they were a year ago, so there's more affordability in the market, especially as prices are flat, inventory is higher. There's a lot more value in the market than there was last year. But the second reason is counterintuitive. Every day that rates fall, it gets cheaper and cheaper every day they wait. But when rates start going back up, the opposite happens. So we could see a sudden burst of contracts in March that actually might be misleading. Our March reporting in April, which is about 3-4 weeks from now, you might hear people say March was much stronger in spite of mortgage rates being high. This is all a little bit misleading because these are buyers that were already planning on buying that are now jumping into the market. And what we could see is offset in April as mortgage rates come back up to where they were the previous year and maybe even go higher than they were last year. We could start seeing a real dampening effect in April and May. This is, again, why we look at leading indicators and pay attention to real-time data, not the monthly reporting that comes out from mainstream media. Now, another thing to keep in mind is that different parts of our market are behaving very differently. This is where buyers really need to pay attention. At the top, $2 million homes and above, contracts are actually falling and active listings are growing. This segment, most tied to the wealth migration, the out-of-state relocators from the higher-end markets, that buyer pool seems to be pulling back. If you have been watching a $2 million plus property, the next few months could bring real seller motivation if this trend holds. Meanwhile, the most active segment in Nashville right now isn't the entry level. It's the 1 to 2 million range, the upper end, but not the ultra luxury. That's where contracts are growing the fastest. Interest rate sensitive buyers have picked up too, but the real energy is in that upper band. I want to slow down here. I think what happens next is different from what the current data suggests. Now, the buyers who are in the market right now, who are already committed, pre-approved, actively shopping, and emotionally ready, when rates spike, that group doesn't slow down. They speed up. They rush in to lock before things get worse. That initial burst makes the market feel much stronger than the underlying demand actually is. We saw that most extreme version of that in 2022. Reactive purchasing or reactive selling almost always ends badly. The deeper concern is this. If mortgage rates are still meaningfully lower year over year, and contract volume still can't pull away from last year's pace, that points to something beyond rates. And I think the headwinds are building. AI anxiety is one that people underestimate. I felt it firsthand this weekend. I built a detailed market analysis report for one of my buyers using AI, and the output would have taken me days to produce manually. My honest thought looking at this was, am I even useful? I think people in dozens of industries are quietly asking themselves that same question. And that kind of uncertainty makes you very cautious about signing a 30-year mortgage. Then there's the inflation risk. Oil is volatile. The Iran conflict is unresolved, and energy costs have a way of rippling through everything. And then there's the wealth effect. When stock portfolios swing, people feel less rich, and they spend accordingly. We've already starting to see that play out in the $2 million plus segment. Something does seem to be holding buyers back in the headline numbers that the headline numbers don't capture. So what's actually going to show up in the data over the next few weeks? Well, I think March will look strong when the reports come out in April. You'll see encouraging headlines about closings and contract activity, but everything closing in March was already under contract. Those deals were done. The real signal is the new contracts being written right now, and that's what I'm tracking week to week. My read, March prices come in flat to slightly negative year over year. Don't let a stable median price lull you into thinking that nothing has changed. You can watch your street lose value while the metro median holds flat or even ticks up. If rates stay elevated, the uncertainty drags on, I think we see a meaningful pullback in activity heading into late spring and summer, and we'll feel it before the data confirms it. And that's why leading indicators matter so much, and why the reports people read are often telling them about a market that's already shifted under their feet. For buyers, your costs went up, and that's real. But this market is giving you tools you haven't had in years: selection, time, and leverage. Inventory is up 13%. You have almost 1,000 more options today than you had last year. Days on market are stretched, but they're not even real with the number of relistings that have come back on. Even price cuts are higher than what is being shown. Buyers who negotiate are averaging about 3% in concessions. Closing costs, rate buy-down, price reductions, you should be asking. That said, not every situation calls for the same approach. I just went under contract with a buyer this week at full list price, and they still gave us concessions on closing costs. The property was already well priced. It had been on the market less than 24 hours, and the showing traffic made it clear it would draw multiple buyers. Sometimes the best value is not a discount, it's speed. For sellers, this is the part that sounds hard to hear, but it's important. Your buyer's cost just went up dramatically. Whether or not you think your home values changed, the math on their side shifted. We have 13% more listings than a year ago. More sellers are cutting prices. You are not in the same position you were 3 years ago. The sellers who are willing to work with these buyers on price, concessions, and terms are moving their homes. The sellers who are not are sitting. And in a market with rising inventory and rising carrying cost, sitting can get expensive. Nashville's fundamentals are still strong. Job growth, migration, a diversified economy. We're still seeing headlines like Starbucks announcing jobs are coming. This is not a market in free fall, but it is a market in transition. Rates are at their highest level of 2026. The data you see next month is going to tell you about a market that's already changed. Watch the leading indicators, be skeptical of backward-looking headlines, and don't make big decisions out of fear. I'll keep tracking the data that matters most and share it with you every Saturday. And with that, thanks for watching. I look forward to seeing you next Saturday. Have a good weekend.